Welcome back, investors. Thanks for joining in. Today we'll be looking at PayPal. As we all know, PayPal has been struggling for a while now, setting in its all-time high of $308 in 2021, with it now trading at $57 a share. Yesterday, PayPal released its Q4 earnings, which was in line with analyst expectations, beating on both EPS and revenue, it having grown 8.1% year over year. You might think why the stock is tanking by almost 10% today. Well, PayPal guided below expectation, with EPS in line of that in 2023. Besides that, I couldn't find any meaningful metrics that were disappointing. We have a slight drop in active accounts, but that was offset by a higher average transaction count per active account. To get a broader insight of the financial performance over the years though, we'll be hopping over to QuantView, our stock insight tool. Here we see a solid uptrend in revenue numbers, which hasn't been interrupted. Free cash flow peaked in 2020 and has dropped slightly the years after. This is further reflected in the earnings per share and net income, which also peaked in 2020, it having dropped quite a bit the years after. This drop in profit margins could give us an idea as of why the stock hasn't been performing so well. Long-term debt has been in an uptrend for some years now too, it being larger than their cash position. This is not necessarily concerning since the debt to EBITDA has always remained in check. Something that I personally find remarkable is that quite a decent chunk of the operating cash flow is stock-based compensation, but in defense of PayPal, their free cash flow yield has exceeded 10%, which for a company like this is very high. Now that we have a general idea of how PayPal has been performing, let's zoom into some of these metrics to see if PayPal fits our preferences when valuing a stock. We'll be performing our valuation in 3 steps. First is the margin of safety. In this segment, we'll be assessing PayPal's key metrics and ratios to determine if we should be more or less cautious when determining fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, financial health, and the growth of the company. And we'll be using a standard margin of safety of 30%, that can never go below 0%. The margin of safety will be based on a bunch of different metrics, and to determine how much we should increase or decrease our margin of safety, we'll be using a scale. Or we're using 4 colors in a scale. Bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at revolve around growth. Here we'll be looking at the earnings per share growth and the free cash flow per share growth. Over the years, PayPal has managed to grow their earnings per share, going from 78 cents a share to $3.35 a share. We'll only be looking at the past 5 years though, and during this period, the growth rate is 22.2%, which is looking very solid. This gives them a 10% deduction in a margin of safety. We also have the free cash flow per share growth, which, like we saw earlier, has put in its peak in 2020. In the past 5 years, the average growth rate was negative 1.21%, meaning a 5% increase in the margin of safety on this metric. Next up, we have the financial health, where we'll be looking at the debt to EBITDA and the Altman Z-score. Debt to EBITDA is calculated by taking the debt of the company and subtracting the cash from it, and then dividing it by the EBITDA, giving us the amount of years of EBITDA needed to repay all debt. This for PayPal is sitting at 43%, which shows a lot of strength in their balance sheet. In other words, a 5% deduction in a margin of safety. Altman Z-score is a ratio used to predict whether a company is likely to go bankrupt or not. It is formed by using a bunch of metrics like working capital, total assets, market cap and sales. When a company scores lower than 1.8, it has a higher chance of going bankrupt, while a score of 3 and above means that it is very safe. PayPal scores between these two with a score of 1.9, meaning that there might be concerns about the financial health, but that it's still relatively safe. The next segment is focused on us, the shareholders. What is the company doing to reward us if we hold the stock? Since PayPal does not pay dividends, we will not be looking at this metric, but PayPal does do buybacks however. They reduced their share count from 1.2 billion shares in 2014 to 1.1 billion shares in 2023. A reduction of 8.6%, which is in the green part of a scale, indicating yet another 5% deduction in a margin of safety. And lastly, we have the capital allocation metrics, where we'll be looking at the return on equity and the return on invested capital. This first ratio is calculated by taking the net profit and dividing it by the equity. It's sitting at 23%, which falls in the green part of our scale, indicating a 5% deduction from margin of safety. Besides this, we have the return on invested capital, which is calculated by taking the EBIT, tax rate, and the invested capital. This ratio gives us an idea how effective the management is at allocating capital. For PayPal, this ratio is sitting at 17%, which is a nice and high ratio that we love to see. This yet again awards them with a 5% margin of safety deduction. It's looking very good for PayPal so far. But now that we've gone through all of our metrics, let's go look at the valuation models next to determine the intrinsic value of PayPal. The first model that we'll be using is the discounted cash flow model. As we can see, the cash flow has gone up over the years for PayPal, going from $1.7 billion in 2015 to $3.2 billion almost in 2023. But we did see a large decline going from 2020 to 2023. In this model, we'll be laying out three cases: a normal case, a best case, and a worst case scenario, where in the normal case, we are projecting a short-term growth rate in a free cash flow of 8% and a long-term growth rate of 5%, with a 9% weighted average cost of capital and a 3% perpetual growth rate, which both we'll be using in the other cases as well. In our best case scenario, we have a 13% short-term growth rate and a long-term growth rate of 9%, and in the worst case scenario, a 5% short-term growth rate and a 3% long-term growth rate. Taking all of the cash flows from all of these cases and weighing them accordingly, we get a sum of cash flows of almost $70 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $67 billion. Dividing this by the amount of shares outstanding, we get an intrinsic value of $62, which is 9% above the current price. The next model that we'll be using is the multiple valuation. Here we'll be looking at similar companies to PayPal and be looking at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is sitting at 20.02. All stuff to do first then is to multiply it by the earnings per share that PayPal is generating, which is $3.84 a share. This gives us an intrinsic value of $77, which is 35% above the current share price, meaning that it's significantly undervalued on this metric. And lastly, we have the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we usually use to determine this are the dividend yield and the PE ratio. Since of course PayPal doesn't pay any dividends, we'll not be using this metric in this valuation model, but we can however look at the PE ratio. And I've imported the PE ratio of the past 5 years, and on average it has been sitting at 38.35, while the current PE ratio is sitting at just above 17. This is a mean deviation of 55%, indicating that our intrinsic value of this model is $88, which is the same upside as the mean deviation, which is 55%. Now that we've gone through our valuation models, let's go look at the final overview of our valuation next. Looking at the final overview, we've imported discounted cash flow, multiple valuation, and a mean reversion theory price per share, giving us an average of $76. Margin of safety we've determined earlier, using a standard margin of safety of 30%, deducting by 10% for the earnings per share growth, and 5% for the debt to EBITDA, share buybacks, return on equity, and return on invested capital, and adding 5% for the free cash flow per share growth, leaving us with a margin of safety of 5%. Applying this margin of safety, we get an intrinsic value of $72, and with the current price of $57, this gives us an upside of 27%, indicating that per our valuation, the stock is undervalued. If however you don't want to use this method of determining a margin of safety, maybe because you have other preferences that I, for example, have, then let's just, for example, plug in a margin of safety of 20%. And even when we plug in a margin of safety of 20%, we still get an upside of 11%, which is looking pretty nice. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And if you want to get access to our valuation models and the stock insight tool that we've shown earlier, you can check in the description for our Patreon link. This would support me greatly. And thanks for watching.